So welcome everyone. This is curated panel. I'm Jonathan, your moderator. This is Qiyu. Our moderator and our guest today is the one and only Joseph Wang. He is a former senior trader at FRBNY, the man quite literally conducting open market operations and Fed policy. Joseph comes with a lot of experience and depth, and he has a new book that he just released a couple months back called Central Banking 101. And this book is fantastic. When I heard about it, I definitely recommend it to all the members of the club because, I like talking about STIRs, and, oftentimes there's a lot of questions that regard it because, this stuff can get very boring very quickly. And so, this book was just perfect because I've already read your blog as well, fedguy.com, and, it's written in a way that's really easy to understand. And, we have a lot of members of the club that picked it up and also thought the same as well. So you're doing God's work right now, Joseph, educating people on how the plumbing works, because this stuff is pretty important. And, a lot of times it's difficult to even find the resources to, where to even start if you're curious about it, right? So, I just wanted to ask you, like, what even gave you the idea to write this book? Because I mean, like, it's super valuable. Like, what made you decide to, one, do the blog, and then two, write this book?
Thanks, Jonathan. Thank you for your kind introduction and your support in promoting the book. And first of all, I'd like to thank everyone for taking time to listen to me. So I guess the first reason I wrote the book is kind of as a way to, well, I guess I'll step back a little bit and talk about how I first ended up at the Fed and why I got interested in monetary policy. And I think that might be helpful in
Sure.
understanding why I wrote Central Banking 101. So I started my working career right after the financial crisis, so in 2009. So at that time, all people could ever talk about was what was happening in the markets. So, we had quantitative easing, we had a huge financial crisis, and I was really curious and excited as to what was going on. And I watched the Dow gyrate hundreds of points every day, and I didn't really understand what was going on, but I really wanted to. So I read enormous amounts of blogs and papers on quantitative easing and what the Fed was doing, all the stuff about reserves and things like that. And I didn't really understand it. And it was really hard for me to find good resources as to to explain to me what was going on. It was really only after I joined the Fed and I was on the open markets desk, focusing on money markets, that I began to have a better picture as to how this whole system works, just exactly what the Fed is trying to do and how it feeds through the financial markets. And one of the things that I realized is that it was really hard for someone who is not in the Fed to have a good idea as to what's going on. And I mean, I've seen many people, even people from, I guess, have fancy titles or on TV talk about these things, but they don't really, I don't, I don't perceive them as fully understanding how the system works. And part of the reason is just that it's so opaque. When you're on the open markets desk, you have access to tremendous amounts of information. Um, for example, you can see everyone's reserve balances all the time, and that's what I could see. And when you talk about things like the reverse repo operation, one of the things that I did was run it, and so you can see every day who comes in for how much. You can when it comes to how banks operate, you could also see banks' regulatory reportings that they file every day. You see what their liquidity profiles are, and in addition to all this regulatory and financial data, you also have a lot of relationships just through the open market stuff. So you get to talk to bank treasurers, you get to talk to primary dealers, you get to talk to big investors, money funds. You get to understand why they do the things they do and how they perceive the situation. And so you get a really good inside view as to how I guess the plumbing of the system works. And it's really hard to develop that view unless you're in that situation, simply because it's so opaque. Now, if you're talking about something like the repo market, for example, you didn't really have any good public data on that until a few years ago when the Fed started publishing SOFR. And it's $1 trillion market and one of the most important markets in the entire financial system. So I felt that being on the desk and finally being able to make sense of this myself and having had such tremendous curiosity of this, um, earlier, I thought it'd be helpful just to put something together to create a book that I would have appreciated when I was learning about this. And so to hear that it's been helpful to others, to me, it's exactly what I intended and tremendously encouraging.
Yeah, absolutely. I mean, the book is like, listen, I'm not that smart. I'm probably missing a few chromosomes, but the way that it's written, I think is really digestible in terms of like the concepts, right? Because they can be very eye glazing, right? But in terms of how like the book is just structured in general, I mean, you can get through a lot of the content, and you go down to the footnotes, and if a little bit more seasoned um, and seen this type of material before, I mean, you can go into the footnotes and your explanations to further expand on it. I think is actually very helpful. I've already looked up a couple BIS um, references that you've given, and so yeah, it's fantastic.
Yeah, definitely. I try to make
Yeah.
it as accessible as possible, but for those of you who are a bit more seasoned, as you know, there's a footnote section and there's also special boxes that go into topics a bit more in depth. And for those that are more interested in current events or things that are a bit more in depth, I also have a blog that you mentioned as well, and that goes to, I guess it's more of a professional audience than the book. One of the things I realized when I started writing this blog, and again, it was also intended to help people understand just how the monetary system works, was that most people actually weren't that interested in how the nuts and bolts and plumbing. It was seemed to be the people who subscribed and had the most feedback were people from uh, I guess, the professionals. So the blog became a bit more professional targeted than whilst the book is more, I guess, introductory.
Right, and um, obviously you're still making this blog out as well. Is there anything else that you plan to do with all this knowledge in terms of sharing it with everyone else? Any more books that you have coming down the pipeline, or maybe some new material and new content?
Yeah. So I'm always trying to figure out, trying to build new content. Some of the things that I think about is trying to, I guess, so make the data more accessible to the broader public. For example, when it comes to understanding some of the plumbing in the system, what's really useful is figuring out what the primary dealers are doing, who are major intermediaries in the market, and what the money funds are doing. So being able to take that data and perhaps put that in a way to create visualization tools on the website just to help people learn. But again, a lot of the times what I write for is for you guys. So I want to understand what people are interested in and what people find difficult to understand. So very much what I write is guided by the input I receive from forums like this and from Twitter and from emails.
Awesome, yeah. And so hopefully maybe you can get some live feedback here and after we finish some of these introductories and a couple questions. Again, everyone, I just want to reset the room. This is Rates and Monetary Policy with Joseph Wang of fedguy.com and also fedguy. Fedguy, what's your Twitter handle, Joseph? It's fedguy
That guy, 1, 2.
one
Oh,
two. There it
the
is.
other, yep, it's the only one that wasn't taken.
Yeah, that's funny. All right, so I guess we can move on to the next part. So I have a couple questions for you. I think it's kind of interesting to think about, right? Because if we think about what the Federal Reserve does, um, it is like you've said, it is kind of opaque. Like, what exactly is monetary policy, and like furthermore, like what are the tools that they use, right? And what I really want to get at is like what is money when it comes down to the fundamental premise of how this whole system works.
Yeah, that's a great question. And a big part of how I think about things is to figure out just what money is and where does it come from. The way that I look at it, there are four different types of money in the system. The one that we are most familiar with are, of course, currency, which is the piece of paper that we have in our pockets. That's a very tangible form of money. The other type of money that we're very familiar with are bank deposits. Now, bank deposits are the numbers that you see when you log into your checking account. Those are actually not created by the government. Those are created by commercial banks. The way that commercial banks create these bank deposits is literally out of thin air. When they create a loan or purchase of an asset, they actually create a bank deposit. to pay for them. But so even though these are created by commercial banks, they are in practice though they are kind of risk-free because the government, at least in the U.S., guarantees bank deposits for most people. If you have less than 250,000 in your bank, it's basically a risk-free form of money. The other two forms of money are ones that we as retail investors are less familiar with. The third one is reserves, and that's money. It's a special type of money that is created by central banks, in this case, the Fed, when the central bank buys or creates something. And it can only be held by someone who has an account at the Fed. If you like blockchain or Bitcoin, you can think of it as having, you have to have a Bitcoin address to have a Bitcoin because you have to be on that ledger. In the same way, if you have to hold reserves, you have to have an account at the Fed. And so this is a risk-free form of money that the Fed creates that you can only hold if you have an account at the Fed. Now, generally speaking, you have to be a bank to have a Fed account, and that's not strictly true. As we know, people like the TJ, the Treasury has an account at the Fed as well. But generally speaking, it's mostly commercial banks that hold this type of money, and whenever they pay each other with this type of money. So that's why people often say that reserves are used as interbank settlement. The fourth type of money are basically treasuries. Now, a lot of people think about treasuries as kind of an investment, but in the modern financial system, you can also think about treasuries as just money that pays interest. Just like a $100 bill is printed by the US government, so is a US treasury, except that it has interest. And of course, if you go out into, let's say, a 20, 30 year, you also have interest rate risk. So there's some duration aspect to it. But the closer you get to, let's say, a 1 month bill, the more cash-like it becomes. And so it really is a sort of form of money, especially if you're a large investor. A lot of times in understanding how this works is to realize that there are different participants in the system and they have different constraints. Now, if you are a big fund manager and you say you have $1 billion, or maybe something very wealthy with $500 million, you really can't just, have bags of currency in your house, or you can't just dump $500 billion into your commercial bank account. That's a significant amount of credit risk. So what happens is that you usually put your money in treasuries as a store of value. And there's something what's special about the treasuries in particular is that it's one of the deepest liquid markets in the world. So when you put money in treasuries, you can actually either repo it out, let's say take a temporary loan against it for cash to buy stuff, or you can just sell it. It's a super deep liquid market. On average, it's about $500 billion in transactions each day, and $1 trillion in repo each day. So when you see people who have huge amounts of dollars, let's say China, for example, they keep it in treasuries because for them, that's a form of money. And how these now bearing in mind that there are 4 different forms of money, that's a very useful framework in thinking about just what the Fed is doing, what the Treasury is doing, and how that impacts asset prices. For example, in this framework, then, when you have massive amounts of deficit spending, one of the ways you can think about this is that the Treasury is printing a lot of money to buy stuff in, and that obviously inflates asset prices, which is what you've been seeing most notably the past year.
Yeah, so that's interesting, right? So like that whole transaction, when you think about it, obviously it really is just swapping liabilities for assets, right? Within that whole chain. So
Right.
if we think about like, right, so we have these 4 forms of money, right? And it seems like at any given time, it's probably pretty simple to figure out at least how many bank reserves are in the system, right? We can pull that up. And
Yep.
we can go and see how much treasury debt is out there, right? By liabilities, we can look that up. Is it possible, though, to get a full picture on, let's say, I guess what it would come down to is bank credit, right? As being another one. Is that another way to kind of just think about, like, is that possible to really get a good understanding of that?
That's possible, but it's difficult. And you raise up a really good point, Jonathan. And that is that when it comes to dollar credit created by banks, bank deposits, it's not easy to get a complete picture because the dollar system is a global system. In the U.S., banks domiciled in the U.S. create credit, and you can see that very clearly in the regular filings that they file with our government. But banks offshore also create dollar credit because the dollars are used throughout the world. So if you have a bank, let's say in Japan, and they have a client that wants to borrow dollars, then that Japanese bank can also create bank deposits that are dollar denominated in Japan, and that really wouldn't show up in some of our statistics. Now, the BIS has some statistics on that, and it's also very good, but less frequent. So, roughly speaking, I think about a third of the dollars uh, in existence in the world are actually outside of the United States. And tracking that, of course, is very useful in understanding what's going on in the world. But like you mentioned, it is a bit more difficult. And something else you can think about is that because the dollar system is so global, the Fed actually controls monetary, uh, has economic influence beyond what happens in the US. Because when the Fed lowers rates, um, that lowers dollar rates for everyone in the world. And so dollar created is created in the US as people go and borrow at lower rates, but it's also created abroad. Yeah, let's say in Japan, in Mexico, in China, and so forth. And so when rates are low here, they actually create credit throughout the world, and that kind of boosts inflationary impulses, not just in the US, but globally.
So that's interesting. So, okay, so how does that whole like? I guess it's easy to understand, right? How the Fed and Treasury can create money, right? But so, and I guess like a little bit easier or slightly easier to understand how commercial banks create money. But how does like an offshore institution create money in the way like of dollars, right? If I'm Nomura in Japan, right? Like how does that work? Because you know it seems like it's counterintuitive. Like they should be only be able to create yen, but they can also create dollars.
Absolutely. I guess the way to think about, well, it's actually, they would work exactly in the same way as a domestic bank would work in creating dollars. So the way that a domestic bank creates dollars, let's say you have a dollar loan, then what happen, $100, let's say, then on their asset side, they would just add $100 in as a dollar loan asset, and then they would just go into their checking, on their liability side and add $100 to your checking account. And that's all a commercial bank has to do to create money and create a loan. Um, of course, the challenge to this is managing liquidity. Let's say you take that $100 and you withdraw it, and then you pay someone who banks at another bank. Then your bank would have to manage that liquidity. Well, either it could already had enough liquidity to make that interbank payment, or would have to go borrow that. So that's basically how a domestic bank would create money. And in Japan, or any foreign bank, does the exact same thing. Difficulty, though, has to do with a foreign bank usually doesn't have as good access to dollar funding as a domestic bank. So going back to our earlier example, let's say the domestic bank created $100, but usually domestic banks have enormous amounts of retail deposits that are very sticky. So it has a whole lot of deposits on one side and reserves on the other side. And you can see that in the banking sector right now. So even if there are outflows, they can easily manage those outflows because they have so much reserve liquidity. Now, foreign banks, though, they don't have the stable retail deposit base. Since if you're in Japan, you usually don't have retail depositors depositing dollars. So they have to go into the wholesale funding markets to borrow those dollars to have stable liabilities. So usually what happens is that those foreign banks would either have to have, let's say, a presence in the US and they can borrow from their branch offices in the US, or they would have to go into the wholesale funding markets, let's say through the FX swaps or through the money markets to borrow that. Um, and that really is the key to the whole offshore dollar banking problem, and that foreign banks have dollar loans, but they don't have stable dollar funding, whereas US banks have that. And so that mismatch between the stability in funding is what causes occasionally these offshore dollar markets to blow up. And you saw that um, during the financial crisis, and you saw that during COVID when you saw the FX swap basis widen a lot. One of the things that the Fed has done is essentially uh, opened up its FX swap lines, its dollar lending operations to the whole world. So, in a sense, post-COVID, the Fed effectively is backing the entire dollar banking system, even those that are outside of the U.S., through its FX swap operations. Um, just going back a little bit to your question, one wrinkle is that sometimes, if let's say you're Nomura in Japan, you might not necessarily have a reserve account at the Fed. And if that's the case, what you would do is you would actually hold as reserves a bank deposit in a US bank and use that to settle your payments. And so, in a sense, an offshore banking is kind of like a fractional reserve banking system built upon a fractional reserve banking system. Instead of using Fed money as its reserves, it uses the deposits created by domestic commercial banks as its reserves. And because of that, another way to think about this is that there's really no limit to how big the dollar banking system can grow.
Right, because you
At
just
least
need
in
people
terms of
to,
reserves. You just
because you
need to
need,
have deposits. Yeah.
yeah, interesting. So, like, I mean, that's just kind of weird to think about, but yeah, I guess that does make sense. It really comes down to if you can settle all these transactions, right? Because,
Exactly.
yeah, because
So
if it
if
just
you
really
are,
something, go
if you're a
ahead.
domestic bank, you can settle that with reserves. If you are an offshore bank, then if you don't have a reserve account, you can hold bank deposits at a big US bank and use and rely on the US bank to settle your payments for you.
Fascinating. So that's interesting. So the Fed has these FX swap lines open right now, right?
Right.
And like, I mean, this like kind of backstops, like you said, the whole world. So as the dollar becomes more global, do you think this is going to be like an ongoing, I guess, policy tool that the Fed is going to keep open, or do you think they're just doing this right now because COVID is still here, right, and there's issues, or do you think this might be a permanent, I guess, regime going forward?
I think it's going to be a permanent regime going forward. So, I mean, one of the basic purposes of a central bank is to be a lender of last resort, right? So let's say you are a bank, you have sound loans, but sometimes you just run into a little liquidity trouble and you borrow from the Fed or from the central bank. Um, so that's that's the discount window. In a sense, the FX swap lines are kind of like that, in that you have banks offshore outside of the US who have dollar books and they have some liquidity problems. What they do is that they borrow from their central bank, who in turn borrows from the Fed. It's in the Fed's interest to keep the dollar banking system uh, working properly because it hurts short-term interest rates here when banks offshore have trouble. When banks offshore have trouble, they start borrowing in US dollar money markets, and that drives interest rates higher. And that's what happened. That's what drives the FX swap basis wider, and that's what drives LIBOR as a spread to IS higher. And that affects the Fed's ability to control interest rates and stimulate the economy. So another way to think of this is that the Fed really can't control interest rates unless it also is able to stop the offshore dollar system, because the interest rate markets between the onshore and the offshore world are the same market for money.
Right, because eventually it has to settle onshore again, right? And so if you have issues liquidity out, offshore, it's definitely going to show up onshore, right?
Yeah, I
Um,
mean, let's say that back to your example, let's say there is a Japanese bank ran into liquidity problems, the Fed would not lend to the Bank of Japan, who could not lend to them. Then what would happen is that that Japanese bank would show up onshore and borrow us all the dollars that it can. It would drive short-term interest rates higher, and that would impact the Fed's ability to control interest rates, which, it's kind of its basic, one of its basic competencies.
right. So maybe take a step back real quick though, because I just want to make sure, not only that I understand, but the uh, the whole room understands is like how exactly does a central bank liquidity swap work then to backstop if you have this type of stress within the offshore funding markets? How does that transaction whole work out?
Yeah, so let's say let's use we'll use the BOJ as an example. So what happens is that the the if so the Fed does a swap with the BOJ and the BOJ does a swap with the Japanese bank. So let's say it's $100. Then the Fed gives the Bank of Japan 100 US dollars. The BOJ will give the Fed 100 US dollars worth of Japanese yen. So the Fed prints dollars out of nowhere. The Japanese BOJ prints yen out of nowhere, and they exchange this. And then the BOJ then holds an auction for dollar funding, which the distressed Japanese bank participates in. And usually the distressed Japanese bank would put collateral up at the BOJ, and the BOJ will then give them the dollars. So it's not the Fed doesn't interact directly with the banks, but always through the foreign central banks. And yeah, the Fed actually just keeps the yen that they receive as collateral and doesn't do anything with it. So it just kind of stays there.
So, I mean, in theory, there is quite literally like fungibility of all. I mean, not all, but for anyone that has access to the swap line with the Fed. I mean, you're talking about Japanese collateral. I imagine it's probably what, JGBs or something like that. If that's the case, then like, is all currency within those jurisdictions technically dollars, or they can be transformed to dollars, I guess, as long as there's demand for it, right?
Yeah. I mean, I
That's
think one of the trades, let's say if you are a Japanese bank, what you could do is you could take your JGBs, right, and you can just swap them for treasuries, and then you can take those treasuries and you can come onshore to the US and repo them out for dollars. So when the system works well, you can convert all this stuff to dollars fairly easily. I mean, you have to pay transaction costs and all that, but they are when the system works well, it's pretty easy to just move things around.
interesting. So, like, I mean, this seems like it works, but are we missing anything? Like, is this going to like this seems almost too good to be true, though? Or, I mean, is it
Well,
just going to function fine for the time being?
so so sometimes you run out of dollars. For example, if you remember in 2019, there was kind of an explosion in the repo market, right? So certain sections of the dollar markets seized up because there wasn't enough money. But right now, what you see is that the Fed has added so much liquidity into the system. All the money market rates are floored at the RRP floor, and you have enormous take up in the RRP, which is where excess liquidity flows. So in the current environment and probably for the foreseeable future, I would expect all this liquidity to be quite orderly, and you wouldn't have blowups like you would see in the past, where someone suddenly doesn't have enough money because there's just so much money in the system. But in the past, you definitely, as you mentioned, things could blow up, and you see them blow up regularly.
Man, so that treasury basis carry trade is probably going to get real big here, huh? If
Oh, well, so treasury basis actually isn't as popular as it used to be. So the treasury basis trade is, a hedge fund basically sells the futures and then buys a cash treasury, funds in a repo, and then delivers that treasury into the futures, right? It's just harvesting very small price differences between the cash market and the futures market. And you're right that in theory, that when you have repo rates really low, you would expect a funding leg to be cheap. But I think that that has not come back a lot because part of the reason is, I think the basis is not as attractive as it used to be. It's not as wide as it was. But when you have big blowups in March, um, it takes a while for people to come back. And I think a lot of treasury basis trades lost a lot of money last March.
yeah, I remember reading about that one fund that got taken out. Kind of towards the COVID lows that we had right there, right? I remember reading about that.
That's a lot of funds lost
Yeah,
money there. It was not good for them. And so usually what happens is a popular trade blows up, people go away, but it comes back after a few years.
yeah, people just can't get enough of that tasty carry. Um, so like, I guess maybe changing gears a little bit. Like, how exactly do you see the Fed operating in the future, especially when you have frameworks like AIT, right? because I think it's definitely a departure in what we've seen in the past in terms of at least how they're looking at inflation. Granted, um, this isn't one of the only things that they're looking for in terms of taper and eventually when to hike rates. But like how does this whole new framework work within, I guess, the views in which what the Fed is watching for?
So the Fed has this new framework where it's going to try to target average inflation, right, over a period of years. I actually find that whole view to be a little bit, silly because it's obvious that over the past 10 years, low rates don't necessarily generate inflation, and it's not clear that the Fed was ever able to generate inflation to begin with. So I think it probably perceives itself to have a lot more control over inflation than it actually does, and not just the Fed, but the ECB and the BOJ as well. They keep rates low. They sometimes take them to negative, but that's just not necessarily how inflation works. Part of the reason is just because central banks can't spend; they only lend. And if you can't spend, then you kind of can't generate demand. And if you don't have demand, then it's hard to have inflation because you need to have obviously demand to push against supply, so to speak, to have inflation. Um, I think what we're heading towards, though, is going to be a conflict between the Fed's goals and what's happening for the Treasury. So what's really big, just I think even bigger than what's happening with this average inflation targeting framework, is that the fiscal authorities in the US seem to be open to spending a lot of money and to do so without any pushback. And so during COVID, the US had this huge fiscal package. I think we had about 4 trillion in deficit spending last year, and we talk about doing even more. Now, that is obviously inflationary because you are buying buying a whole ton of stuff, right? So at the same time, if the Fed wants to keep its inflation mandate, it's going to have to push against that, push against that. And so that I think is a difficult thing to do politically because you're basically fighting the elected officials. So I think the challenge going for the Fed going forward is just how to navigate that, maintaining their framework, even though I think the elected government is obviously pushing towards policies that are very inflationary. If, for example, there's another $3 trillion in stimulus and infrastructure coming in a few months, and I think it's reasonable to expect that inflation will continue to remain pretty high. Is the Fed just going to raise rates then? I mean, I think this old Fed is, ultimately part of the U.S. government. Is it able to maintain that framework, even when the political and elected officials would rather the Fed not to do things like that because it could hurt asset markets and so forth? So I think that going forward, that would be the difficult challenge for the Fed to being able to push back against the fiscal authorities and maintain its independence.
And that's interesting. So, like, if you have like, I guess like this type of like push and pull, like how exactly then do these decisions get rolled out, right? Because if you do have, um, you have to maintain, I guess, like a political lens, if you're Jerome Powell, like what exactly are you looking for then? Because I mean, it's going to be definitely a difficult area to navigate, right? Not only because you want to keep your job, but let's think about the person who is eventually selected to be the chair, right? So, like, do you think Jerome Powell is really going to look at inflation as being, um, something that is going to force, maybe not force, but the FOMC is going to come together and say, listen, we got to do something about this. Do you think that's really going to happen? Because at least historically, it seems that the Fed has tried to create inflation, and now you're actually seeing some above 2% prints, right? Do you
Right,
think
right.
that I mean, it almost seems like it's fascinating, right? Because they can't get it when they want it, and then when they get it, it doesn't seem like they can control it because it is really outside their toolkit, right?
Yeah.
So how do they
So
manage that?
that's a really good question, and that reminds me of an interesting article that I've read. So I guess I'll step back and give a little bit of a framework as to how the Fed usually controls inflation and how it's different in a fiscal dominant world. When you don't have the Treasury spending a ton of money, then money is almost completely created by commercial banks, who obviously have longer dated loans and shorter dated liabilities. And so the commercial banks make money through that spread between, say, like a 5-year loan and what they pay their depositors. So when the Fed changes the overnight rate, then what happens is that instantly changes the interest rate margin for commercial banks. When the Fed raises the overnight loan, then the overnight rate, then the interest rate margins for commercial banks shrink, and they're less likely to create more money because it's not as profitable. And the reverse happens when the Fed lowers the overnight rate. Then the interest rate margins for commercial banks widen, and they're more interested in creating more money. And of course, more money into the system, more economic growth. So when you have a system that is largely determined by private banks, I think the Fed has a lot more control over how money is created. But when you come to this world now, when the U.S. government is doing 3-4 trillion in deficit spending every year, then those tools don't really control how much money goes into the system, because the Treasury really doesn't care what the overnight rate is or even what the 10-year Treasury yield is. It just borrows, right, and the Fed will pay for it. And so, in that context, the Fed's toolkits of changing interest rates have less effect on inflation, simply because the biggest spender in the economy doesn't care about interest rates. There's an interesting blog post by a Fed economist, David Andolfi, on this. And in this framework, though, what the Fed could actually do if it wanted to, if it didn't have control over the fiscal authorities, is it would actually have to lower interest rates to lower inflation. And that sounds counterintuitive, because why would you lower interest rates when you wanted to fight inflation? But if you think of if you think of money as being primarily created through deficit spending, and the largest interest, then the only way that you could reduce that amount of money is by reducing interest payments of the fiscal authorities. All right, so the U.S. government has about $400 or $500 billion annually interest rate payments. It's the largest borrower in the world, in the dollar world. So if you couldn't control what their fiscal spending would be, and obviously the Fed can't, the only thing you could do was control the amount of interest that they have to pay, which of course they borrow, right? So they basically print interest as well in treasuries. So counterintuitively, in a world where the fiscal authorities do whatever they want, to make inflation, to reduce inflation the best it can, the Fed would actually reduce interest rates. It's an interesting thought experiment, but it is how it would work if we continue down this path where all we do is spend trillions of dollars every year.
I mean, that it's counterintuitive, but it does make sense, right?
Right. Because you have to think about, I mean, if the Treasury had $500 billion in interest, all that means is that it's going to print treasuries and pay that as interest, right? So
right.
Fiscal spending is a form of money. And if you can't control the quantity of money through commercial banks, because all the money is a ton of the money is coming from the fiscal authorities, what you would do is you have to find ways to reduce the amount of fiscal spending. And the way that you do that as a central bank, the only power lever you have would be to reduce their interest payments.
Yeah. Money's weird when you think about that, and especially inflation. Yeah, that's fascinating. Well, we're getting about to 2/3 into the hour, and so we're going to open up the stage to anyone in the audience that would like to come up and ask Joseph some questions. So please raise your hand. I got Richard up here. We'll get up, and we also have Jay as well. So,
hey guys, Joseph, thanks for taking the time to speak with us. Great opportunity. So let me ask a fun question. Hopefully it'll be fun just to kind of get some of us casuals involved. What are some misconceptions you often hear in the media or in the financial press or on CNBC that kind of really set your jaw at a weird angle that you maybe want to dispel for us?
Honestly, I oftentimes I hear all these conspiracy theories about what the Fed is actually doing or something like that, with sometimes a nefarious or mastermind tone. Uh, I would actually present to you that the Fed is, it's government. It's much more post office than in this bank. There's really no man behind the curtain. There's no master plan or grand conspiracy. It's just kind of a bunch of people in offices trying to get by. So um, when the Fed does something wrong or it doesn't really have an ulterior motive, it sometimes it's just that, makes a mistake or doesn't really know what's happening and just kind of fumbling along. So, uh, when you think about the Fed, I would think about, like a post office worker than anything else. It's, it's not a very sophisticated organization in my experience.
So is it like smart or valid to think of the Fed as a monolith, or is it kind of important to pay attention to the different, local and regional Feds and the various opinions that come out from quote unquote the Fed in different ways?
Okay, great. So that's a really good point. So the Fed is a ginormous organization. It has many different regional banks, and each bank has a president, and each president has its research staff, and they have all their own views. But the truth of the matter is, most of them don't matter. The power center of the bank is what they call the troika. So that's the chair, the vice chair. So it's Powell, it's Clarita, and it's Williams. Those three people are the most influential people on the Fed, and they kind of what they do, what they want to do, they do, and everyone else is really not that important. Um, that being said, though, that I think in terms of learning how the system works and what's possible, it's useful to pay attention to what's happening, what's put out from the other Federal Reserve banks. For example, just a couple years ago, there was a blog post in the St. Louis Fed about a standing repo facility, and that's something that was floated around and kind of dismissed and forgotten about, but now it's come back in a big way, and you see that mentioned in Fed minutes all the time. So to your question, pay attention to Clarida, pay attention to Powell, pay attention to Williams. Everyone else, much less important in my experience.
Thanks. Richard, you're up on the stage, man. You got a question?
Yeah, thanks for having me up, and thank you, Joseph, for being with us today. I'm a fixed income portfolio manager at a large official institution, and I just finished reading your book, Central Banking 101, this afternoon. I have to say, I thought it was an excellent and timely primer on how the monetary system works, so thank you for that. I'm definitely going to have to buy that for our analysts and interns going forward.
Thank you very
So
much.
Yeah, so moving on to my questions, my focus is specifically on agency mortgage-backed securities portfolios. So I have a couple questions on the Fed's involvement in the MBS space. So first, when the Fed buys mortgage-backed securities, it has a few different effects. It takes duration out of the market and suppresses the yield curve a little bit. They sell interest rate volatility by buying MBS, which helps to reduce market vol. It pushes down primary mortgage rates for homeowners and supports the housing market. And it also reduces the yield on mortgage-backed securities, which pushes investors out the risk curve and ultimately helps to reduce the cost of funds for corporations. So my question is, out of these, what do you think is the primary reason the Fed is buying MBS? Or do you think it's a combination of these factors? And do you think the Fed is worried about the housing market getting overheated?
So I I think that's a really good question because many people are wondering why the Fed is buying agency MBS. So when Jerome Powell was asked that at his press conference, he, in my opinion, did not give a very good answer. Basically, that they are Treasury adjacent and they bought them back in the financial crises. Um, for me, and I mean, if you look at their official communications, it talks about uh, easing, I mean, easing the financial conditions. So it seems like it's all the things that you mentioned above. That being said, though, I mean, I think that we could probably accomplish the same thing with just buying treasuries as well, since agency MBS in large part priced off of treasuries. And that being said, if you think about why when the Fed first started buying agency MBS back in 2008, that was because there was a crisis in the uh, mortgage-related asset markets, and so the Fed was trying to provide some stability there. So, I agree with you that the buying agency more MBS reduces volatility, lowers the primary mortgage rate, eases financial conditions for borrowers. That's all true, and I guess that's why the Fed continues to do that. And so I think that is probably what they're doing. Yeah. So I just think that perhaps we could do the same thing with buying treasuries, and it has always been the Fed's goal, I think, to have more of a treasury portfolio. So, but if you're an agency MBS fixed income manager, imagine it's quite a good thing.
Yeah, thanks for that. And I remember them saying that they probably would not be buying MBS again in the next crisis. And then once COVID happens, what do you know? They started buying it again. So my next question is a little bit more technical. But when the Fed does buy MBS, they buy for forward settle using TBA contracts. And the people that sell those TBAs to the Fed have to deliver mortgage-backed securities. But sometimes there's a collateral shortage in the market, and the Fed has to delay taking delivery on those contracts. So I'm curious if you have any insight into when the Fed decides to roll those TBAs and delay settlement on those TBAs. Do you think it's more about the financing rate implied by those contracts, or do you think they do a sort of collateral supply and demand analysis?
So they try to monitor discussionist in the collateral to make sure that it's not basically that's not too. So the Fed really doesn't want to affect market functioning. So if in the Fed's judgment that the collateral is getting too special, then they'll just roll it, and they will just basically roll it to the next settlement period. And exactly what the threshold is, I'm not sure, because I wasn't on the mortgage team, but that is what happens.
Got it. Thank you. And last question, do you think we'll see any regulation around mortgage REITs, which had a permanent destruction of capital last March?
Well, the mortgage REITs, as you mentioned, the mortgage REITs basically they borrow and repo, and they're long mortgage rates and mortgage agency MBS, and some of them are long non-agency MBS as well. And last year during COVID, they had enormous destruction of capital. So it's some of them went bankrupt, and some of them barely survived. Hopefully, that was enough to teach them not to overlever and perhaps ramp down the risk a little bit. I haven't heard of um, any extra regulation coming down that might further impact them. But you're right that did seem to be a source of instability in the market last year. So it would make sense if the regulators were looking into that. I read about them looking into the prime money market funds, and so I imagine that they would also have the REIT section, the mortgage REIT industry in their eyes as well. But I haven't heard of anything specifically.
Got it. Well, thank you very much, Joseph.
Thanks for the questions, Richard. Neely, how are you doing today?
Hello. Jonathan, Qiyu, thank you so much for hosting this in AMA. This is amazing. Joseph, I too am an owner of your book because Jonathan is definitely a central banking 101 pusher in the group. So yeah, I don't know what the royalty rates are there, whatever, but he's worth it. Okay. So, here's the question I want to ask. Actually, there's two, if you would indulge me. The first and foremost is it's a high level question. I would consider myself central banking like 001, getting better. But I love big system thinking, and the fact that you are a plumber, right? Like you understand the plumbing of the monetary system. And so I just maybe simply asking you the question, when I think of plumbing, when plumbers come in and fix problems, right? There's the obvious drip that occurs that you can see, right? As you open up the undercarriage of a cabinet and see like a a plumbing problem. But then there's like the leak in the ceiling and you don't know exactly where that came from. Knowing what you know, and for a casual like me, what would be like the top like 2, 3, 5, whatever things that you would have us watch very closely to understand where those leaks might be before they become big cracks? That's the first question. And I know it's a big question, then I'll have a very specific question.
Yeah, so I think that's a really good way to think about things. Just what are the risks going ahead? And when you talk about plumbing specifically, though, I think what you really want to think about is that so the purpose of a market is to distribute things that are scarce. But when you have things that are not scarce, like air and so forth, or water, you don't really have any price for them. And what's happening right now is that the Fed is creating so much liquidity, it's basically not scarce anymore. And so you have everything going down to the RRP offering rate. You have bills trading close to zero. You have repo floored at the RRP rate. You have a lot of money that is just kind of flowing into the RRP facility, and it's going to get even more. So in that world, I don't really think there is any problems with the plumbing. The thing about if you look back in the past, crashes happen when someone doesn't have enough money, and then they have to go and they have to either sell assets to get cash, or they have to pay up more in the wholesale markets, and that forces rates higher. In this context, though, what we're having that we haven't seen never before happened in the US before, it's happened in other countries before, is that there's so much money in the plumbing that people don't have any need for it. And part of this is regulatory as well. That short-term money is not as useful. So what I would watch is that what do people do if they have to earn income, but they just can't get any in the front end? Usually that means that they're going to have to go further out. Let's say, either in lower quality or further in tenure, so more duration risk. And you're seeing that a little bit already when you have, for example, there's an article in Bloomberg talking about how junk bond yields are below inflation. And maybe what we see in, say, the belly of the curve moving lower has a little bit to do with what's happening with too much money in the front end as well. So I guess I would just assume that the plumbing is going to be zombified for the foreseeable future, and to see how that impacts all the asset classes, whether or not there is going to be a push into more and more risk, more and more duration. And eventually, though, I mean, plumbing can't break, but things that are, let's say, risk assets, for example, those can still be subject to panics.
That makes so much sense. Thank you very much for that answer. And then this is a very specific question. It's around student debt. So the Wall Street Journal has been publishing, I think, some really good research and thinking, just thought leadership in general about do we have this problem of a potential hole in our, financial budget, as it were, right? That could be possibly bigger than the SNL crisis because of the way that we're valuing student loans. I realize it's probably more of a Treasury issue than a Federal Reserve issue, but I guess the question would be, are you familiar with some of the work that's being done out about that? Do you think that that is potentially an issue in terms of how maybe these loans are being valued? And then what would you have us watch? Because, I mean, it looks like basically every time the education department comes short on this thing, they have to ask the Treasury to feed their budget. And it's done without budgetary oversight. And it's done, it's a little sneaky. So I guess the question is there a way to monitor this in a way that we could assess us plebeians, whether or not this is really an issue or not? Thanks.
So what's interesting so usually when you have a lot of buildup in debt, it's a problem because, let's say, whoever owes that money can't pay it, and the people who lent the money are get in trouble, and so you have these, I guess, panics or deflationary cycles where basically a lot of debt turns out to be bad, and so everyone loses money. Yeah, I mean, you saw that back in 2008 during the subprime mortgages, right? There's a lot of subprime mortgages. People borrowed money they couldn't pay back. So the people who lent that money ended up losing a lot of money, right? And so that fed through because people were investing on margin, and that created a spiral. That really can't happen in the student loan universe because basically all student loans, well, the vast majority, are guaranteed by the federal government. And so when the student defaults or can't pay their student loans, Uncle Sam just kind of eats that loss. So there's kind of no financial stability implications. And maybe that's why the federal government took over the student loans. I mean, there used to be uh, basically all government-backed loans are originated by the government now. I mean, there are private alternatives as well, of course, but the vast majority are by the federal government. So I don't really see that as any financial stability implication. And odds are there's probably going to be some kind of political solution that makes all the student loan a lot more bearable for the borrowers as well. But if you're interested in just the number and level of student loans, there is data on that that's published regularly. I can't remember right now where it is,
It's the New York Fed.
but yeah, it's a big number,
Yep.
but yeah.
I'm familiar with the
But
data.
if
Yeah.
yeah, but that's all backed by the federal government. So even if everyone defaults, uh, the the government would just take that loss, and the government doesn't really care about that because they print money.
All right. Thank you. Thank you so much for being here with us this evening.
Welcome.
Thanks, Dealy. Alfredo, how you doing?
Hi.
Got a question?
Yeah, great discussion, Joe. I am enjoying it very much. One of the things that you mentioned is the fact that this push-pull conflict between uh, and Jerome Powell's efforts to use monetary policy, and it is a conflict, right? Because the job of the federal government is through fiscal spending in order to promote economic growth, whereas the monetary policy should be independent. And they have similar type goals in the sense that they're trying to promote employment growth at the same time as managing inflation. When the two collide is when we have what we have, which is this potentially enormous fiscal stimulus bill and the current interest rate environment and purchasing program. Don't you think, though, that there is a happy medium in the sense that monetary policy, not only interest rates, on just using the interest rate lever to control um, interest expense at the Treasury level, because the Treasury could always just issue out T-bills on the short part of the curve. The Fed can continue buying on the long end, and the curve is then um, somewhat suppressed, albeit there might be a little bit pressure on the short end, which is again part of the function to try and promote inflation anyway. But there could be some in curve control through Fed purchases, um, in some instances through the interest rates or the interest income that's coming in. Um, right. So don't you think there are multiple levers in order to maintain growth, maintain some semblance of inflation without the massive boom in what would be M2 as a result of potentially greater um, fiscal stimulus?
Yeah. So the M2 thing, the growth in M2, a lot of it has to do with, just like you mentioned, how the Fed is implementing its rate control policies. It's doing it through purchases in the medium to long end, right? Quantitative easing. And one of the byproducts of that is a lot of M2. And there are more efficient ways to do the exact same thing. And you see Japan doing that, and you see Australia doing that. And that is basically yield curve control. So let's say the goal of large asset purchases is to lower longer dated rates. One way you can do that is you can be like the Fed and you can just buy a few trillion. And another way to do that is just say, you know what? I think that let's say the 10 years should be 1.3. And if it ever goes above 1.3, I'm going to buy it as much as I can to keep it low. All you have to do, for all this interest rate has to do then, is just say that the market won't challenge it. and then you'd be able to have control over interest rates without these large asset purchases. It would definitely be a lot more elegant if all you're trying to do is control the interest rate. And you see people talk about that. I think Brainerd has had a few speeches about yield curve control. It would be, as you mentioned, a more efficient way of controlling interest rates without seeing this explosion of M2. It would not necessarily, it won't have any effect on deficit spending, of course. That's the purview of the Treasury. So if you believe that, let's say, inflation impulses are from QE, then because of M2, then you can think of this yield curve control as nullifying this. But if you think of inflation as coming from large-scale deficit spending, then you could still have then this yield curve control framework, even though it would not increase M2 as much, might not work against inflation.
But you would argue that if the fiscal spending were to grow, then the private sector, there's a fine balance in when you look at GDP, right? So it's either public sector spend or private that helps to contribute to GDP,
Yes,
right?
that's
So,
right.
and so if the private sector is coming online stronger, then the public sector can taper back. Now, I think people also missed a lot of discussions on the infrastructure bill, but this is a 10-year infrastructure bill. So the annual spend is only a couple $100 billion. It's not like, that headline number that people keep hearing about. But those are my thoughts. Thank you.
So yeah, I think one thing that I would note, in just having worked in the public sector, is that the people who run the public sector are really no wiser than you and I. And I mean, and of course, they have their own incentives as well. And I think to just cede a lot of control over how the direction of the economy to these people who really just want to win elections and have their own personal interests as well is something that I think we should be cautious about. So maybe if we have very good enlightened central planners running everything, things work well, but that's not what it happens historically. So I guess we'll just have to see how this unfolds.
Awesome. Thanks for the questions, Alfredo. Igor, welcome to the stage. You have a question?
Yeah. Hey guys. Thanks for hanging out with us today, Joseph. My first question is, are you familiar with Richard Werner's work? He specifically writes about that central banking is actually not like a fractional reserve system. And then the second thing he talks about, and these are just like very high level concepts, but that interest rates are a lagging indicator of inflation as opposed to a leading indicator of inflation, which is like quite relevant because everybody's kind of uncertain exactly where interest rates are going to go from here. It seems like for a long time they've been trending down, and we've obviously haven't been experiencing headline inflation for like the last 10 plus years since QE began, but obviously 2020 and 2021 has changed that. So that's my first question.
No, yeah, I'm familiar with Richard Werner and his Princes of the Yen. I think Richard Werner is a brilliant economist. I encourage everyone to read and follow his work. I think one of his, well, I'm not familiar with that idea of interest rates being lagging. As I understand, one of the things that he talks about is that rates and inflation move together. And I think that is actually how it worked. Well, actually, I'll give some historical context here. So, and part of this has to do with the structure of the world, how it changes. Pre 1930s, inflation and interest rates actually moved in the same direction, and this makes sense intuitively because rates are basically the price for money. And so, when you have a boom, when you have an inflationary era, there's more demand for money, right? By definition. And so interest rates are supposed to go higher. But here, though, what we do see now, though, is we think that lowering interest rates raises inflation, right? So it's kind of a big structural change in how people perceive how it works. And I think that has to do with how the public sector is just so much bigger than the private sector. Now, back then, you had much smaller involvement from the public sector. But here, if there's there's inflation, then it's like bad for risk assets because the reaction function is that the Fed will raise rates, right? And so there's kind of a shift in how this is perceived, and these shifts happen throughout the decades, and so that relationship between interest rates and um, inflation, that it does change. So it's not always easy to see, and you can see this through the Fed's own framework as well. They used to talk about a Phillips curve, and the Phillips curve hasn't worked in, let's say, 10 years. So things are always changing. So it's kind of hard to have reliable indicators, and to say that because rates are low, maybe that it's lagging, and that could be, but rates today are very different than where they were earlier in the century. It's much more of a policy right now. The official sector controls basically huge amounts of the curve and maybe all of it eventually. So I don't know if it has the same economic signal as it used to. So
Yeah.
another way to think about this is that if you think about rates as a global market, then what happens in, let's say, the BOJ's yield curve control framework has to have an impact on what happens domestically as well. So even if we don't have things like yield curve control, that what happens abroad through the markets places constraints on where our yields can go as well. So because we become less of a market determined economy and more of a, I guess, official sector determined economy, I think it's harder and harder to read signals into what the rates market implies about economics, just like relationships change. And so it could be different today.
Right. Yeah. No, that was very informative. I think I generally agree with your. I think it's largely been decoupled. And then my second question, in chapter 2 of your book, Central Banking 101, you talk about R star, which is basically a metric that the Fed uses to measure the rate of interest over time. And so I know that the metric's not being kept up to date anymore. I think, but I was just wondering. I looked it up today. I noticed that it's been trending down ever since like the 60s and 70s, and typically when it trends down, the economy is expanding. You mentioned inflation is rising and unemployment goes lower, and then when R star trends up, the economy is slowing, inflation is declining, and unemployment is ticking higher. So from my perspective, we've actually seen the economy expanding, inflation declining, and unemployment kind of being a little bit choppy here or there. So I was just wondering whether it was like a useful metric to use, and then why has it been trending down for several decades now?
So central banks are model-driven organizations. So they have their big models, like you mentioned, R star. It's really big in the central bank because it's run by economists. But I would take a step back and think R star is, like you mentioned, low, and that's what people all over the world say, and they talk about things like demographics and so forth. And so what some central banks do is, well, R star is low, that's easy. I would just move rates negative. And that's what the ECB does, and that's what the BOJ does. And it hasn't worked at all. So that I would say that you know, maybe thinking about the world as a big equation for economists to solve is not a super useful way for them to approach the world. And so I to say that it's trending lower or higher, uh, I don't know if that's a useful model to think about the world. And that's definitely how many of them think about it. But I to say that it's why is it trending lower, and I don't think it's a super useful concept to begin with, and I think the history of the failures of the ECB and the BOJ just show that. So I don't really think a lot about why our star is or lower or higher. I just don't really think it's useful.
Thanks, appreciate it.
So this is rates and monetary policy with Joseph Wang of FedGuy12 at Twitter. He has a new book out called Monetary Policy, Central Banking 101. You can get it on Amazon right now, and it's on Kindle as well. And we're just going over a couple questions. that the room is being invited up to ask Joseph, pretty much anything that he wants. Well, not everything, but specifically to rates and monetary policy and maybe even capital markets. So if you have any questions, please raise your hand. We'll get you up here and you can ask your question. But on to you, Jay.
Thank you.
Got a question you want to ask?
So I have two questions, and the first one, Joseph, maybe you could have some fun with. Anything interesting you want to tell us about the process of researching your book, writing your book? I mean, were there any kind of rabbit holes that you tried to go down and then maybe had to back off, or was there any kind of fun research process where you discovered something new or from an interesting source? Usually writing a book is a big deal. So anything from that process that you want to share?
One of the things you hear people say is that to learn something really well, you have to be able to, to teach it, and that was my experience as well. Oftentimes, I felt that I knew something, but I wanted it to be well researched, and I wanted to have data, and just going through this whole process of just pouring through just the papers and the data on this, it was a learning experience for me as well. And so I thought that just the entire process just made me. I was learning as well as I wrote that. A lot of the things, a lot of the finer points that I might have missed. So that no, that was, and actually I think it was a great experience. I actually encourage everyone to write just that one book in your life, just to have the experience. It's not as painful as it sounds because you know you actually get to kind of challenge yourself a bit, but you also have an opportunity to really think about whether you understand something as well as you think you do. And in my experience, I didn't, and just by going through the process, it really strengthened my understanding a lot on all the subjects that I wrote about.
Oh, that's cool. So while we wait for more people to jump up here, I'll just ask a couple of quickies. So is there any source out there that you really love to kind of consume, be it video, written, like any other folks who you think are worth paying attention to on the analytical side of evaluating the economy who are alive?
Yeah, so I think for just so my interest is obviously in uh, just monetary system. If you have an interest in this, what you really want to read is what happens or it's put out by the BIS. The BIS is it's kind of like a central bank. So they have access to just confidential data, not just from the US, but from central banks throughout the world. And so they're in a position to put together some very good research and insights as to what's happening in the global economy and in the dollar system in particular. The Fed actually doesn't have a super good grasp of what's happening in the dollar banking system or the dollar capital markets worldwide because it only has power to collect regulatory data within the US boundaries. But the BIS, through its relationships, has a much fuller picture. So if you're interested in, say, the dollar system, I would definitely encourage you to follow up with what the BIS is writing about, especially people like Claudio Borio or Bob McCauley. Those are just some of the world's foremost experts in that subject. I also have a lot of interest in dollar money markets, and if you're interested in that, of course, the giant in that field is someone called Zoltan Bolzer. He's a rate strategist at Credit Suisse. So you can find his posts either through Google or on Twitter. He doesn't post it himself. Someone gets his information and posts it online. So that stuff you can get publicly as well. So if you're interested in the dollar system, those are the three people that I would recommend that everyone read.
Thank you very much, Joseph.
Thanks, Jay. Hey, Suki.
Oh, hey guys. Hey, Joseph. I have a quick question. What's your prediction for the 10-year by the end of this year?
Oh man, that's such a hard question, right?
Well,
Because
that's what I'm
as you know,
asking.
so as you know, inflation prints are pretty high. If you look at the Treasury, so the Treasury actually has forecasts as to how much debt they're issuing. The coupon issuance is at record highs. It's going to go higher. The administration is telling you they're going to issue more debt. They're going to have more deficit spending. We have all these inflationary impulses, and yet the 10-year just goes lower and lower. One of the ways that you can look at this, though, is to realize that just like when you look at, let's say, AMC or Tesla, like people, those stocks go higher because there are a lot of people buying them, and they buy them for all sorts of reasons. It's not necessarily that there's some kind of sound economic judgment, PE or earnings or things like that. And when you look at rates, and I think traditionally we think of rates as being a realm of very many smart people and with strong ties to economic fundamentals. And that's definitely true, but there are also many other people in the market participating as well who don't care about economic fundamentals a bit. And obviously, that's one of them is the Fed, who's buying, let's say, 80 billion a month. You have other people like, say, foreign central banks, reserve managers who are just buying treasuries because they need a place to park their dollars. Remember, treasuries are kind of like a form of money. PBLC can't be parking $1 trillion at Citibank, right? And you also have a lot of people who are buying treasuries because it's, part of their life cycle. Let's say the boomers, the wealthiest generation in the world, they're retiring, and you can kind of very clearly see them shifting into fixed income, not necessarily because they think inflation is going to be low, but because we live in a culture where we are told that when you are approaching retirement, you tamp down on risk and you buy fixed income. So you have a lot of people, market participants in the rates market who are not economic fundamental driven. So it's very difficult to just look at economic fundamentals and have an estimate as to where the 10-year should be according to fundamentals. But I would expect us, just to be around here, just going forward. On the one hand, you're just going to have so much issuance coming forward, and it seems like, and I'm not particularly sure, that we seem okay. So another thing you want to think about is that, as you know, we're printing a lot of money, right? We're buying a lot of stuff, but all asset prices rise when you have a lot of money. It's not just people going to buy equities, not just people going to buy houses, but people buy bonds as well. So on the one hand, you have just more money coming into the system. On the other hand, you have the Treasury issuing more. And so I haven't done any exact math to see where these fall, these bounce, but I think that we will just kind of stay within a 50 basis point range throughout the year.
Oh, wow, that's interesting. Thanks for that. I mean, largely everything you said is definitely what I've sort of read and come across as well. But it's just because I've read some analysts who've kind of predicted closer to 2%. I'm just a bit curious why they would get to that figure, because it's quite a deviation from where we are with only, what, 4 or 5 months really, realistically. So,
Well, it's a good prediction. If you wanted to look at where inflation is, you shouldn't, would you expect the 10-year to be so much? Well, I guess, it depends on how you view the future, though, right? But I mean, if you think that the administration is going to be running inflation policies for the foreseeable future, and if you look at what's deficit, that seems to be how the U.S. government operates, it would make sense for yields to go a bit higher. But there are other considerations as well.
thank you.
So just are you implying that it's entirely feasible for the federal government to spend more money at its current clip?
I think of the way that these fiat monetary systems, a lot of confidence in the U.S. government. It's a confidence that's been built up for, right? U.S. has been the world's superpower for some time, and for most of the prior century, I've been the militant force. So people have a lot of confidence in the dollar. You see people in developing countries who don't have confidence in their own systems, they hold dollars. So as long as that confidence remains, and you could still print a lot of dollars, and I think that people would still hold them, and I think you could have inflation be subdued. But once people lose confidence in that and begin to think, hey, maybe these multi-trillion-dollar deficits are a structural part of how the US will operate, you might see different reactions. You might see people go into hard assets, things like real estate, maybe precious metals, equity market, and so forth. And maybe you see some of that already.
Yeah, interesting. Go ahead, Sharuk.
Hi, Jonathan. Hi, Joseph. Thank you for letting me up. I just have one question. I mean, sorry, I was in and out in the middle, but with regards to, I mean, has a technology bent towards it when I ask this particular question? Say, when you define money in traditional terms, when we have cash, we have the economics of that. But do you think the every central bank digital currency concept that is coming up, will that have a substantial effect on the way we understand economics and the dealings of money post its intervention into our day-to-day lives? And what would your take be on that from a federal perspective?
Yeah, so the CBDC is definitely an interesting idea. It's hard to say too much about it because there's many different ways to implement this. Broadly speaking, one way to implement this is to have it as a digital bearer instrument, basically digital cash, so it lives on your device, your cell phone, or something like that. Another way to think about it is to have it as basically give non-banks access to the Fed's balance sheet. So you have an account at the Federal Reserve, right? So you could have reserves, you could hold reserves, so to speak. Um, for me, though, I think I have trouble understanding why we even need central bank digital currencies. The currency system works very well for me right now. At least, I mean, for me, I pay things electronically through my credit card. I see things in my checking account. I go to the ATM. My have barely any fees. My payments are instant. Everything works really well, and I'm never afraid of credit risk because the FDIC ensures tons of my tons of my money in my checking deposit. The credit card company protects me from unauthorized charges. I'm not quite sure what a CBDC is supposed to add to me, but what I could see the CBDC being useful for is for people who have tons of money, more than the FDIC insurance. So let's say I have $5 billion, and I then in that case a central bank digital currency makes perfect sense. I get to have a risk-free asset. And right now, I guess I could go to bills, but then I guess bills are very low yielding. Maybe the CBDC will yield higher. So I don't really think of the CBDC as necessary in a I guess an advanced economy, but it could be helpful in some other economies that have payment systems that are not as developed. But what I do think, though, is that the CBDC does introduce a way for the central bank to have greater control over monetary policy. So, just as an example, right now, the way that the central bank puts a floor on interest rates is through the reverse repo facility, right? If you had a CBDC, maybe you could just adjust the CBDC rates, and you won't have to rely on, let's say, money market funds to control the interest rates. You could just do it directly through a CBDC. So I think a CBDC, it gives this public sector an extra dimension, more policy tools. I don't actually think it's something that I need or it's super useful for for the U.S. I mean, let's say you have a developing country who doesn't have a mature payment system, then I can see that um, uh, maybe an official sector solution would be better than relying on local banks.
Thank you.
Thanks, Drew. Hi, Nick. Welcome to the stage.
Hey, Joseph, I also have CBDC question. So you mentioned a couple of functions for CBDC or potential functions. One of them is the ability to have a direct account at the Fed. Do you mean the 25% of the US household could directly have a bank account at the Fed? So potentially most of the population then could become banked without being banked.
Yeah, so I think one of the possible ways you can implement a CDBC is just to give everyone an account at the Fed, and everyone would be able to have um, a reserve account basically. And the difference between that and the commercial bank is that it's a liability. It's a liability at the Fed, and it's the Fed is a good counterparty, can't default. So I think one of the proponents of CBD, one of the one of the selling points of CBDC is that it could um, bank people who are unbanked. And maybe that's true, but I'm skeptical of that because, well, if you want to have a bank account, there's just so many banks in the US and they have very good services. I mean, if you go to Capital One, they even give you free coffee. So it's very easy to have a bank account in the US. I have difficulty seeing how the Federal Reserve can improve upon that. They certainly will not be able to give a better user experience. Um, and I would expect some portion of the population to always be unbanked, if only because they don't have any money.
The next question, thanks for the first one. I have the last question about actually one and a half more.
But
So
no problem.
sorry. So if other countries have CBDC, it's almost like they have a better technology. Therefore, if other people have a better tool, potentially they can be better performing versus us, the US. So would you think that it's not a matter of if, but when?
So, well, better is something that you have to judge according to purpose. So, I would have to, we'd have to look at this in a case by case basis. In what way would a CBDC better? Would it be faster than in transactions than what we have now? Would it be safer? And it could be, but like I mentioned before, just from my own personal experience, I have my payments are instant. I don't ever worry about uh, the money in my checking account disappearing. Um, I I don't see how I would benefit from a CDBC. I can definitely see if you had a lot of money, if you would want it in a CBDC rather than in a bank, or if you didn't want to have treasuries for some reason. Um, I think though that there are also other considerations in thinking about that. It's not just about technology and efficiency, but there can be some downsides to having a CBDC as well, and that has to do, I guess, from a more political aspect. Is it a good idea to have so much centralized control on your money? What if, for example, the government decides that, you know what, we don't like you, and because we own everything in the system, there's no more cash, there's only CBDCs. From now on, you can't have a bank account and you can't have any money at all because you're a bad person. So it's not all about, I think, technology and payments. And it's not clear to me that it is an improvement. But if it is, there are also, I think, other considerations as well. Having a CDBC and maybe I would guess implies the elimination of cash. It destroys a lot of privacy, and it has the potential, I think, to destroy a lot of well, personal liberty as well. Because then if the government doesn't like you, then you're kind of completely locked out of the monetary system.
I love that you are honest with your view. I appreciate that. The next question is about the concept of SDR-based CBDC with the US euro, yuan, and yen, and pound proportionately become like a stable coin or CBDC SDR-based. And ideally, instead of having my portfolio allocated to or be nominated into USD, it can be an SDR, and conceptually it could be more stable. Would you agree?
So the STR, I mean, it's kind of it's something, a device held by the IMF where everyone puts in, has STR allocations and puts down some of their own currency. And I, I don't.
So sorry, I need to finish my question. Sorry.
Okay,
I
please.
apologize for cutting you off. So let's say I'm someone that have like a very diversified international portfolio, so not like concentrated in the US. And that's why I would see that holding an SDR portfolio would be nominated portfolio would be more stable.
Yeah, I mean that sounds reasonable, but why would you need a CBDC to do that? Can't you just hold a diversified portfolio together. And more importantly, I mean, you can't go to a store and spend SDRs, right? Ultimately, you need some sort of domestic currency. And so you're going to have to keep in mind what your needs are as well. So, and shape your currency that way. What if you have an SDR, let's say half dollar, half euro, and you need a whole bunch of yen? Then that's not super useful. So I think it has to do with your individual needs as well.
Thanks for the clarity. I'm moving back to the audience. It's fun today. Thanks.
You're welcome.
Thanks, Dean. What's going on, Aaron?
Hey, Jonathan. Thanks for holding the room, and thanks for your time, Joseph, and expertise. In the most recent financial stability report, there was it's dated now, but it's back in May. One of the first takeaways that it talked about was around asset valuations, and that the price of risky assets generally increasing, especially as kind of those interest rates have decreased, and that in the setting that we're in, that those asset prices may be vulnerable to significant declines should that risk appetite fall. I just wanted to get your take or your thoughts on some of those risks, particularly about asset valuations, but maybe any other risks that you would see to the kind of our monetary system.
I think that's a great point. I mean, it seems like the stock market keeps going higher, right? It has to. It seems like the stock market keeps going higher. Asset prices everywhere are going higher. So I think it's understandable to be wary of financial stability risk and potential changes in risk appetites that can suddenly uh, cause big disallocations. For myself, though, I don't. I view that as simply a side effect of just the inflationary policies that are being run by the Treasury. And you can talk about indicators like, well, first of all, when you think about equity valuations, there's kind of a lot of ways to look at this, and you can get very wide results depending on how you look at it. I believe the IMF and the Fed both look at this quite differently. I think one says that equity valuations are high, and the other says that they're not too high. I think one of them uses a valuation based upon relative to, let's say, where interest rates are. The equity equities are not too high, and the other would be based on, let's say, fundamentals and things like that. Maybe they are too high. So I think of this as kind of just a consequence of inflationary policies. If you think that there's too much leverage in the system, you have to keep in mind that there's a continued flow of equity in the form of just helicopter money from the Treasury that constantly delivers the system and gives people a lot more money to spend. So I don't actually worry about asset prices. I think I think that we're on track to just continue to go higher. I mean, one of the things that I've written about is to just look at the number of bank deposits in the commercial banking system. And bank deposits is what most people think of as money. And, just over the year, we're like a few trillion higher. And for people who are retail people, just defined as people who have bank accounts that are less than 250,000, it's like $1.5 trillion more in your checking account. So given all that, it just seems normal for asset prices to go higher. It seems like that's a logical conclusion of just printing trillions of helicopter money and giving it to people. That being said, though, you can always keep levering up until you get some sort of fragility and then have something just collapse. So that's always something to look about to look at. It's hard to be able to point to one particular thing. I don't. I guess conventionally, what you would look at is you would see if, let's say, interest rates spike too much, because that might raise the funding costs of some people and thus force them to delever and force the whole system to kind of take a hiccup. But that doesn't seem to be happening either. So from this framework, though, I guess what I would focus more is just what the Treasury is doing. Are they going to start tightening and start cutting deficit spending? Then that would be a risk to, I think, risk assets more than anything else. Since, in my view, that is the primary driver of what we see in just the rise in asset markets throughout across all asset classes. So if we see some cutbacks in deficit spending, if we see fiscal hawks suddenly say that, we need to balance the budget, I flag, and that's what I would watch for. But it doesn't seem like we're on that track right now.
Thank you.
Great perspective, Joseph. It got me thinking. So it looks like no one else has raised their hands anymore, but I got a question, a couple one that I wanted to ask you specifically. There's definitely these risks out there, right, in terms of financial stability. And if we think about deficit spending as being, like you said, a key component in terms of, if you're long on stocks, you're looking for this to keep this party going. So, as we look ahead towards the end of the month, and there's talks about the debt ceiling and some friction involved, in getting that renewed. Do you think that this is a real threat in terms of, someone can take the proverbial punch bowl away, right? Or do you think this is more or less just political posturing in terms of how we're going to see this all play out?
So just thinking back on the prior few debt episodes, it's always about political posturing, and usually the debt ceiling gets restored. I think it's in everyone's interest to not have the debt ceiling become a big issue, because if it really does become a big issue, then I think there could be some equity market volatility, and no one likes to see that. So in my experience, at least, just looking from the past few episodes, this always gets resolved. So I don't really worry about that. I mean, eventually, it's hard to look at this without a political aspect, but I mean, soon we'll have midterm elections next year, and that's a way off from now. But so there could be some political parties who would take advantage of this, seeing that elections are far off, and just kind of cause some trouble. But I think eventually it gets resolved. Probably doesn't take too long either.
Okay. And, also on term of, Powell, his, his seat's coming up here pretty soon too, right? Yeah. Do you think he gets the nod for another term, or do you think he might be replaced?
So I've been reading reports saying that there's support in the Biden administration for Powell, and I think the argument is that Powell works very well with everyone on Capitol Hill, so that's a good plus. But before that, though, one of the things that I've noticed is that Governor Brainerd seems to be making a lot of noises that are, I think, appealing to people in the Biden camp. She does a lot of talk, for example, on climate change and trying to make one of the Fed's responsibility and policing the financial stability aspects of climate change. And, that's something that maybe she made up, but that is something that I think certain people like to hear. And I think maybe that was playing into maybe that was a way of campaigning for the position. So the way that I look at it, it does seem that if the Biden people wanted someone that was closer to their ideology, they could find someone closer. They could find someone closer than Powell. But Powell has the benefit of just, I think, at least 4 years of experience and a history of working well with people on Capitol Hill. So I don't know, but I would not expect it to be anyone other than, let's say, Powell or Brainerd.
Okay. And the last question, because we're going to wrap this up, but if you look towards the end of the year and I guess maybe onwards, do you see any potential bogeys out there that we should be paying attention to?
So I think though that the concern that we should be, when you say bogey, what do you mean? Are you like risks or things like that?
Yeah, just some other things that eventually have to get resolved.
To me, I feel like there's this debate right now whether inflation is transitory, and I guess you can infer from my discussion this past year where I stand on that. But there's a lot of people who think this would just go back to normal and so forth. In the event that they are wrong, I think there could be some serious market volatility as people begin to reform their opinions of this, and that could hurt things like growth stocks. It could be very good for things like commodities, and it could be disruptive too. And it could potentially lead to some people, like it's selling treasuries, moving rates up a bit, so that could be disruptive. So that's from pure economics. That's the one thing to think about, just whether or not, because this is something that we will know in the coming months. I mean, whether or not inflation remains elevated or whether we really are on track to just go back to, let's say, 2% inflation. So that's one thing that we should be able to find out in the coming months, and that could be disruptive if it does turn out to be something that's persistent.
Right. Yeah. Well, listen, Joseph. I just want to thank you for spending this evening with us all here in the club. You know, it's been really it's been a great discussion, and your experience and your views are immensely valuable to everyone here, not only on the stage but also in the audience. So just want to again just thank you for spending your time here with us.
So I want to thank everyone for inviting me, and I thank everyone for the great questions that were posed today. I enjoyed speaking with all of you, and if you guys have any questions or that I could help with, you can feel free to send me an email, joseph@fedguy.com. Always happy to hear feedback and answer questions. I have my blog, and I put myself out there as a resource to help people understand the monetary system. So feel free to reach out.
Thanks, Joseph. And again, you guys buy his book, get it on Amazon, get it on Kindle. It will listen to when I got into this stuff, I wish I had this book because it probably would have saved me a couple of years just going through blogs and figuring out what's noise and what's signal. So, this might save you a couple of years off your life too, and it costs less than $20. So, it's a great deal. But thanks everyone. We're gonna close on the room now. If you like anything you've heard from Joseph, please give him a follow. Also go on his blog, and we'll do more of these talks soon. And Joseph, we got to get you back on again and talk rates, especially as we get closer to Jackson Hole.